Tariffs are in place, interest rates remain unchanged, but U.S. public debt is soaring. As the markets wait for signs of a rate cut, President Donald Trump openly criticizes Federal Reserve Chairman Jerome Powell, calling him slow, incompetent, and even demanding his resignation. The Fed holds its ground. No rate cuts until the risks are under control. But the White House wants more, faster growth, cheaper borrowing, and a Fed that gets it. Today, we'll use AI tools to simulate a face-off between Trump and Powell over U.S. interest rates and try to understand what's really driving each side. 5 AI judges will score the debate across 6 rounds to answer 2 big questions. Who's right? And who's truly putting America's best interests first?
I'm the President of the United States, and let me say it clearly. Jerome Powell is hurting America. While other countries are seizing this moment of falling inflation to boost growth, our Federal Reserve just sits there, keeping interest rates sky high like we're in an overheating economy. But what's the reality? Inflation has dropped significantly from Biden's 9.1% down to around 2.4%. The job market is steady. And yet borrowing costs for businesses, for families, and most critically, for the federal government are still outrageously high. We're paying nearly $1 trillion a year just in interest on the national debt, more than we spend on defense. That's taxpayer money. Let me ask you this. If rates were cut to 1%, we could save $300 to $400 billion a year. No need to cut Social Security. No need to raise taxes, just one click from the Fed. So why isn't Powell doing it? Some say I'm trying to politicize the Fed. Wrong. I'm demanding accountability. Remember? The Fed kept rates near zero for the entire Obama presidency. But when I took office, even with low inflation, they started raising. And now, as I return with a stronger economy and lower inflation, they're hesitating again. Is that independence or political bias in disguise? We need the Fed to act as part of our national economic strategy, not as some isolated fortress. They can't just sit there while businesses suffocate, families can't afford homes, and the government drowns in interest just because they're afraid to lose credibility. Credibility doesn't come from silence, it comes from action. And now is the time. Cut the rates, take action, or step aside.
Mr. President, I understand your concerns about debt costs and economic growth. But as chair of the Federal Reserve, I must emphasize that our mandate is to ensure price stability and maximum employment based on data, not political pressure. Our current interest rate between 4.25% and 4.5% reflects the economic reality of June 2025. 2.4% inflation and 4.1% unemployment. That's a stable economy. However, the administration's new tariffs are introducing inflationary risks. As noted in our July 1st report, a dramatic rate cut to 1%, as you suggest, may boost short-term growth, but history shows the danger. In the 1970s, political pressure from President Nixon led the Fed to hold rates too low, triggering runaway inflation that hit 12% in 1974 and caused a deep recession. We cannot repeat that mistake. Yes, debt service is a real issue, but low rates alone aren't the solution. IMF research in 2023 warned that prolonged low rates can fuel asset bubbles and financial instability, just like the 2008 crisis. Instead, the Fed is considering a gradual rate cut by the end of 2025, possibly down to 3.9% based on updated economic forecasts, as noted in the June 18th FOMC release. On independence, I want to be clear. The Fed is not opposed to national strategy, but we must safeguard global market confidence. If investors lose faith in the Fed's independence, U.S. Borrowing costs will skyrocket like in the UK in 2022 when reckless fiscal policy triggered a bond crisis. I'm committed to timely action, but action grounded in data, not impulse. A hasty rate cut could hurt the very people and businesses you aim to protect. We are not opposing you, Mr. President. But we do not serve election cycles. We serve long-term economic trust. And I believe that's what America needs most right now.
A heavy-hitting opening round. President Trump zeroed in on public debt costs and the immediate gains of cutting interest rates, a powerful, emotionally charged argument that speaks directly to the public's anxieties. In response, Chair Powell maintained a calm, composed stance, citing historical precedents, the risk of renewed inflation, and emphasizing the Fed's independence as a pillar of market trust. One side calls for action, the other insists on action at the right time. Two opposing approaches, yet both strike at the core: growth, fiscal risk, and the Fed's role as a stabilizing force in an age of uncertainty.
Chairman Powell just brought up the 1970s and inflation under Nixon. Let me be clear, 1974 is not 2025. Back then, America was dealing with an oil shock, the Vietnam War, and a monetary system still finding its footing. Today, we have real-time data. We have AI analyzing every movement in consumer prices. We should not hide behind blurry history to delay decisions that must be made now. And about the UK in 2022, yes, the bond market reacted negatively, but the main reason was tax cuts without funding, not because the Bank of England lowered interest rates. I'm not saying tax cuts should be reckless. I'm saying the government needs access to reasonably priced credit to invest and support its people. Right now, small businesses are freezing hiring because short-term loans carry rates of 8 to 9%. Young people can't afford homes. State governments are cutting budgets because bond yields are too high. These are direct consequences of the Fed's wait for the data policy that Chairman Powell keeps referring to. I am not asking the Fed to break its principles. I am asking for a new definition of responsibility. If a central bank is so independent that it no longer hears signals from the real economy, that independence becomes cold and dangerous. The Fed is not a lab experiment. It is the backbone of the livelihood of 340 million Americans. Look at Japan. They kept interest rates near zero for over a decade and still controlled inflation. Look at Switzerland and Canada. They cut rates in 2025 without destabilizing their markets. And what has the Fed done? Sent out vague messages like, we might cut or we might not. That's not leadership. Finally, if Chairman Powell is afraid that the markets will lose trust if the Fed follows the president's recommendation, then let me ask this. Wouldn't markets lose more trust if the Fed ignores the president, ignores the data, ignores the people? So where does trust really come from? From an Excel spreadsheet or from the real lives of the American people?
Mr. President, I deeply understand the challenges that small businesses and everyday Americans are facing. But I must stress that monetary policy cannot be driven solely by short-term demands. It must account for long-term consequences. You mentioned Japan and Canada, but their situations are vastly different from ours. Japan kept rates near zero for over a decade, but their inflation was also near zero from 1990 to 2020, and their average annual growth was only 0.8%. The United States, with a projected GDP growth of 1.4% in 2025, needs a more cautious approach to avoid inflation spiraling again, especially as your new tariffs could push the consumer price index above 3%. according to the Peterson Institute. As for Switzerland and Canada, they lowered their rates from already low levels, 1.5% and 4.75%. Meanwhile, the U.S. is currently at 4.25 to 4.5%, facing stronger inflationary pressures due to the global role of the dollar. A drastic rate cut like the one you propose could weaken trust in the dollar, raise the cost of imports, and echo the Mexican peso crisis in 1994, when the central bank lost control over policy. You are right that borrowing costs are weighing on businesses and families. But the solution isn't just lower interest rates. For example, Freddie Mac's Home Loan Support Program in 2024 helped ease pressure on home buyers without requiring the Fed to rush into rate cuts. As for the Fed's responsibility, let me be absolutely clear. We are not cold or indifferent. Our decision to hold the current rate is based on data inflation at 2.4%, unemployment at 4.1%, and projected tariff impacts. If we cut too quickly, asset bubbles like in 2007 could return and hurt the very people you're concerned about. I promise this. The Fed is preparing to cut rates, possibly to 3.9% by the end of 2025. But we will do so based on the data, not pressure. Market trust does not come from pleasing politics. It comes from the stability that 340 million Americans and the world count on us to maintain.
Chairman Powell says the Fed does not bend to politics, that it serves long-term trust. But I ask, trust from whom? Bond investors in Zurich or factory workers in Detroit? Right now, the Fed seems more focused on market signals than on signals from real life. He brings up Mexico in 1994, a country with limited foreign reserves, not the issuer of the world's reserve currency. The strength of the U.S. dollar does not come from Fed consistency alone, but from America's political, military, and technological power. That's the truth. Just look at China. They manipulate the yuan, keep interest rates low to boost exports. Meanwhile, we are choking our businesses with expensive capital and watching GDP grow at 1.4%, even lower than during the pandemic years. You talk about asset bubbles. Let me remind you, the 2008 bubble was caused by weak regulation, not just low interest rates. And if the Fed is worried about risky assets, why not use a tiered rate system? Japan tried yield curve control, managing long-term borrowing costs while protecting financial stability. Why won't the Fed consider that? Chairman Powell says the Fed plans to lower rates to 3.9% by the end of 2025. But right now, in July, we already see real pressure. Retail sales have dropped 2 months in a row. Jobless claims are rising. What are you waiting for? Another crisis? Let me be clear. Independence does not mean rigidity. Trust comes from the ability to respond with flexibility. If you refuse to cut now, then when the Fed truly needs to act, the market may no longer trust you. And at that point, all the data you rely on will mean nothing.
Mr. President, I understand your concern for American workers in Detroit and the challenges facing our businesses. But the Fed's mission is to balance the needs of all 340 million Americans, not just one group or one moment in time. You compare the U.S. to China, but their currency manipulation has led to long-term instability. In 2015, capital flight forced the yuan down by 7% in just weeks. The United States, as the issuer of the global reserve currency, cannot take those kinds of risks. Even a hint of reckless policy can spike bond yields and raise borrowing costs, as we saw in the United Kingdom in 2022. As for recent data, it is true that retail sales have dipped by 0.2% over the past 2 months, and jobless claims have risen slightly, But inflation remains at 2.4% and could rise further due to your proposed 10% tariffs, according to projections from the Peterson Institute. Cutting rates immediately from the current range of 4.25 to 4.5% down to the level you suggest could push inflation beyond 3%, eating into the wages of the very workers you are trying to help. Regarding the 2008 bubble, you are right that weak oversight played a major role. But prolonged low interest rates from 2001 to 2004 also fueled the housing boom, according to research from the National Bureau of Economic Research. Your suggestion of yield curve control, as Japan used, can help manage long-term yields, but it distorts markets and weakens capital allocation. Japan's own economy has seen stagnant growth of just 0.8% over the past decade. Instead, the Fed is closely monitoring the data, with a plan to cut rates to 3.9% by the end of 2025, as long as inflation stays under control. The Fed's independence is not about being unchanging. It is about making decisions based on facts, not pressure. Trust from markets and from the public comes from long-term stability, not from reacting hastily to short-term noise. We are acting in the best interest of the American people, and we will continue to do so.
After 3 rounds, the debate has crystallized into 2 opposing schools of thought. Trump embodies the pressure for immediate action, prioritizing growth above all. Powell stands firm on the principle of stability, grounding every decision in data. Trump attacks with real-world urgency. Powell counters with historical context and macroeconomic models. Both make valid points. The American people are under pressure, but history has shown that reckless rate cuts can trigger massive crises. What's commendable is their willingness to confront tough examples head-on: China's currency manipulation, Japan's yield curve policy, the 2008 housing bubble. More importantly, the audience now sees the deeper truth. Monetary policy isn't as simple as hitting the rate cut button. It's a high-stakes balancing act between short-term relief and long-term consequences.
Chairman Powell keeps talking about long-term stability. That sounds great on paper, but I am talking about the financial health of millions of Americans right now, not some perfect model from an economics textbook. If you want to bring up history, then look directly at 1982. Paul Volcker, the Fed chair back then, slashed interest rates from 19% to 11% in less than 12 months because he understood that keeping rates too high for too long would choke off economic recovery. And here's something the Fed rarely talks about. The tools of monetary policy today are not as flexible as they used to be. Why? Because the structure of our national debt has changed. In the year 2000, only 25% of U.S. public debt matured within 1 year. In 2025, that number is over 40%. That means our debt is rolling over faster, and interest costs react instantly to Fed policy. So when Chairman Powell keeps rates high, he is directly raising our annual interest payments to nearly $1 trillion money that could have gone to health care, education, or tax cuts. He also talks about the risk of losing market confidence. But let me ask you this. How much confidence does the market really have when Powell says he might cut rates in the fourth quarter, yet the 10-year bond yield is still above 4.3%? Why? Because the market does not believe he is acting fast enough. The market sees a Fed that reacts after the fact, not one that leads proactively as it should. And finally, if you truly want stability, here's my proposal. Let's coordinate monetary and fiscal policy strategically. I am willing to commit to keeping the federal deficit within 5% of GDP if the Fed brings rates down to 2%. That is a handshake between the White House and the Fed, with accountability on both sides. I am not trying to control the Fed. I want us to act together, not stand on opposite sides. I do not need the Fed to obey me. I need the Fed to listen to the economy, and the economy is calling for change right now.
Mr. President, I respect your proposal for policy coordination. But I must emphasize that the Federal Reserve's duty is to maintain long-term economic stability, not just respond to short-term pressure. You referred to Paul Volcker cutting rates from 19% to 11% in 1982. But the circumstances then were very different. Inflation had already dropped from 14.8% to 6.1% due to prior tightening, which made that rate cut safe. Today, inflation stands at 2.4%, but still carries upward risk from your proposed 10% tariffs, which could push the consumer price index to 3.2%. Cutting interest rates down to 2% immediately, as you suggest, could fuel an asset bubble similar to the one from 2004 to 2007, when low rates helped trigger the housing crisis, according to research from the New York Fed in 2010. Regarding national debt, you are right that 40% of it now matures in the short term, which increases sensitivity to interest rates. But a sharp rate cut would also weaken the dollar, raise import costs, and hurt consumers. The 10-year bond yield staying at 4.3% reflects concerns about future inflation, not a lack of confidence in the Fed, as reported by Bloomberg. If we cut rates too quickly, yields could spike even higher, just like during the UK bond crisis in 2022, when a lack of coordination caused yields to soar to 4.5%. On your suggestion to cap the federal deficit at 5% of GDP in exchange for a 2% interest rate, I appreciate the spirit of cooperation. But monetary policy cannot be based on political agreements. It must be based on data. The Fed currently projects lowering rates to 3.9% by the end of 2025, but only if inflation remains under control and tariffs do not disrupt forecasts. We are listening to the economy from a 0.2% drop in retail sales to a slight rise in jobless claims, and we will act at the right time. The trust of the American people comes from a Fed that is independent and makes decisions in the country's long-term interest, not just in response to immediate pressure.
Chairman Powell, if you say trust comes from independence, I say trust also requires effectiveness and accountability to reality. And the reality is this: we are managing the economy of 2025 with the mindset of 1990. You claim that cutting interest rates would weaken the dollar. But in reality, the U.S. dollar has already dropped nearly 6% from March to July of 2025, and that happened without a single rate cut. Why? Because the market is reacting to political uncertainty and unclear spending plans, not to monetary policy. You keep saying the Fed needs to wait for the data, but if you are truly listening to the data, second quarter GDP only grew by 0.3%, the weakest since 2022, and consumer spending has declined for 3 straight months. You talk about price stability. I ask you this: what is the point of stable prices if people cannot afford to spend? If small businesses are shutting down because they cannot access credit? If states are laying off workers because of rising bond costs? That kind of stability exists only in theory. We need to distinguish between financial risk and social risk. Asset bubbles can be managed with macro tools like leverage controls and capital requirements. But economic stagnation and recession, those are the kinds of risks the Fed cannot fix after they happen. You say interest rate policy cannot be based on political agreements. I am not asking for a deal. I am offering a clear policy commitment, just like Reagan did with Volcker. The government pledged to reduce spending, and in return, the Fed adjusted rates strategically. That was not a political compromise. That was modern governance. If we do not start working together now, then by the time you lower interest rates, it will already be too late. And the American people should not have to pay the price for that delay ever again.
Mr. President, I share your concern about weakening consumer spending and the slow GDP growth of 0.3% in the second quarter of 2025. But I must emphasize that monetary policy cannot fix every economic problem instantly without creating long-term risks. You mentioned the dollar falling by 6% between March and July. But the main driver was not just political instability. It was also growing fears of inflation tied to your proposed 10% tariffs, which are projected to push the consumer price index to 3.2%. Cutting rates down to 2% right now, as you propose, might boost short-term consumption, but also risks weakening the dollar further, driving up import costs just like in Turkey's 2018 inflation crisis, when low interest rates led the lira to lose 40% of its value. Regarding your Reagan-Volcker-style coordination proposal, I agree that modern governance benefits from cooperation. But in Reagan's case, inflation had already dropped from 13.5% to 4.1% before the rate cuts began. Right now, with inflation at 2.4% and additional pressure from tariffs, an aggressive cut could push inflation above the 2% target and erode Americans' purchasing power, something the International Monetary Fund warned about in its 2023 study on low interest rates in inflationary environments. You are right that social risks, like small business closures and home affordability, are serious. But macro tools like leverage limits take time to implement and cannot replace the need for careful interest rate policy. The Fed is monitoring the data closely, from the 0.4% drop in consumer spending to a 5% rise in jobless claims. We are planning to lower rates to 3.9% by the end of 2025, but only if inflation remains under control. Price stability is not just theory. It protects the real incomes of workers and businesses against inflation. The Fed is committed to acting in a timely manner. But for the long-term benefit of the American people, we must act based on data, not short-term pressure.
I want to end this debate with something simple. If Chairman Powell believes that long-term benefit is the reason to not act today, then who takes responsibility for the damage happening every single day? We can talk about potential inflation, but just look at what's happening on the ground. Credit card debt in the United States has just surpassed $1.3 trillion, the highest in history. Delinquency rates are rising fast, and according to Experian, over 32% of Americans under the age of 40 can no longer afford their minimum monthly loan payments. You brought up Turkey in 2018, but let's be fair. That was a country with a large current account deficit, a weak currency, and low foreign reserves. The United States is not Turkey. We are the issuer of the world's most powerful reserve currency. We have a global financial network, and, most importantly, we have the capacity to recover if the right policies are in place. I am not asking the Fed to recklessly slash rates. I am asking you to respond to real data, not hypothetical risks. If GDP only grew by 0.3%, consumer spending is falling, unemployment is starting to rise, and inflation is still under control. This is not the time to wait. This is the time to act and prevent a crisis. I have run a business. I know that if you wait to see flames before reaching for the fire extinguisher, it's already too late. The Fed does not need to respond to me. Respond to the economy. Do not let this become a future case study in textbooks about delay and inaction. If you are afraid of losing credibility by cutting too early, then let me ask you this. How much credibility will the Fed have left if the economy slips into recession? At that point, no one will care about the reasons, they will only care about the consequences. And once again, it will be the American people who pay the price. That is something I simply cannot accept.
Mr. President, I fully understand the challenges Americans are facing, from credit card debt exceeding $1.3 trillion to more than 32% of young people struggling to make their payments. And I assure you, the Fed is not ignoring these warning signs. But monetary policy cannot focus only on immediate pain while neglecting long-term consequences. You are right, the United States is not Turkey in 2018. Our dollar is the global reserve currency, and that makes our responsibility even greater. If we cut rates sharply from 4.25 to 4.5% down to the level you suggest, while tariffs threaten to push inflation to 3.2%, we risk repeating the inflation of the 1970s, when political pressure and low interest rates caused the consumer price index to soar to 12%. It is true that GDP growth of 0.3% and weakening consumer spending in the second quarter of 2025 are concerning. But the unemployment rate remains stable at 4.1%, which indicates we are not on the brink of crisis. Cutting rates too quickly could inflate another asset bubble, like the one before the 2008 crash, when rates stayed low from 2001 to 2004, and home prices rose by 50%, causing greater harm to everyday Americans. You call for immediate action, but history shows that rushing into decisions often leads to instability. In 2011, the European Central Bank raised rates too early and prolonged Europe's recession. The Fed is planning to lower rates to 3.9% by the end of 2025, but only with clear data, to prevent inflation from eroding real incomes. The Fed's credibility does not come from avoiding all risks. It comes from making balanced decisions that protect both workers and investors. We are not waiting for the fire to start. We are already working to contain the sparks before they ignite. I promise you, the Fed will act at the right time, in the interest of all 340 million Americans, with the responsibility to safeguard the economy that the entire world relies on.
After 6 intense rounds, 2 opposing forces, President Donald Trump and Federal Reserve Chair Jerome Powell, have laid out their full visions for interest rate policy, economic governance, and the risks facing the U.S. economy in 2025. Trump pressed hard on immediate realities: weak growth, declining consumption, record consumer debt, and soaring public interest payments. He called on the Fed to listen to the economy, not just the data, and even offered to coordinate policy between the White House and the Fed. Powell, meanwhile, held the line, warning of latent inflation risks, the dangers of premature easing, and defending the Fed's independence as the cornerstone of long-term stability. He emphasized that all actions must be data-driven, not emotional. All 5 AI judges leaned toward Powell, citing his depth in policy analysis, reliance on hard data, and disciplined approach to macroeconomic risk. Economies don't run on emotion or rigidity. They run on the delicate balance between short-term pressure and long-term vision. This wasn't just a showdown between a president and a Fed chair. It was a mirror held up to every voter, investor, and citizen, revealing how a nation handles the eternal tension between politics and technocracy. And now, the question is yours. Will you choose a bold leap toward explosive growth, or a steady foundation built on risk control? Which side are you on?